Hey, welcome everybody to another Thursday night underwriting call. And as we wait for people to hop in, this call is really designed for everybody that is taking real estate and multifamily just a little bit more serious than the people that are on my Monday night call. Monday night, a lot of people come from Instagram, come from all types of different places, just get a little introduction. Usually I have another speaker on there providing some sort of other aspect of multifamily, something else that we can add in there, everything from social media to project management to operations to syndications. All those things are on Monday nights. If you want to see any recordings, they are all on the YouTubes. Tonight, I actually was promoting Brad Sumrock's call, which happens at the exact same time as this one. So maybe some people went over there, but I'm sure that in the next 10, 15 minutes, there will be more people joining this call as well. Ian, I thought that was Brad. Was that Brad that you just showed on your screen, Ian? Oh my God, that's funny. I thought Brad was on this call for a second. Um, yeah, so for you guys that picked me over Brad, wow, thank you, thank you, thank you, thank you. So I have an amazing guest that is going to be joining us today. I don't know if he's here yet, but I will when he gets here. His name is Derek. He works for Arbor, which is a brokerage company that works with agency debt. So agency debt being Fannie Mae, Freddie Mac, different types of life insurance loans. And I was picking his brain last week at the NMHC event here in Las Vegas. And I was just trying to understand how debt works. You know, part of underwriting is to really understand debt. If we understand debt, we can really tell and understand how the economy is and where the market is in terms of all real estate. And I feel like a lot of it comes from, the institutional level. Actually, he was telling me it actually starts really at the pension funds. These big funds, they tighten up their money. So then they're not buying any of the securities. Oh, and he's here. Shh, shh, shh. I think there he is. Okay, so we talked a little bit about how interest rates and why interest rates are at where they are. And after having a whole conversation with him, trying to understand, where why the Federal Reserve pushes things in certain direction, what is happening that has interest rates go up, and they take into account CPI, which is the unemployment rate, and the cost inflation, which is the cost of our expenses. And after having this long conversation with him, I still don't really understand where it starts and where it ends. So I guess I'm just going to have to take it. Okay. If they tell me what it is, that's what we're going to have to go with. And so how do we underwrite deals? How do we protect ourselves? What are we supposed to do in today's market so that we can set ourselves up to win for our future, right? Not only for ourselves, but for our investors. So maybe I'll start today just by taking a couple questions, thoughts, wins, concerns about the market, about where you're at, and then we will get into it with Derek, just so we can give people a little more time to hop into this call. I don't want anyone to miss the valuable information that's going to be shared here. So anybody have any thoughts, any questions about debt, about the market, about underwriting in general? We've done a lot of napkin underwriting, and you can raise your hand by going to the reaction button and hit raise hand, and then we will unmute you and call on you. But we've done a lot of napkin underwriting here. I see you, Derek. We've done a lot of napkin underwriting. We've gone a little bit deeper into the Michael Blank sheet, which is, for me, it's kind of like, it's really enough for me to understand the deal. And then, the LOIs, this call is everything up to closing. Everything after closing is operations. That will be a whole set of different conversation. People that invest with us on Saturdays, we have a call talking about the operations in all of our deals. We talk about how to transition from an LP to a GP. So that's what, people that invest with us get that opportunity to be on that call on Saturdays. We also have a mentorship mastermind program that basically is a handhold journey to help you get onto a deal. The opportunity to be on every single deal is going to be there. Everyone that's involved there. But yeah, Lene, hi.
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 I heard that Freddie Mac or May, whichever, both are doing a special thing this month pertaining to loans, and they're putting them at a lower rate. Do you know anything about that?
Well, I know somebody that does know something about that. So why don't we just in this, if nobody has any questions right now about more basic things, challenges, things like that for yourselves, because Lene, I'm sure that question will be answered, and thank you for that question. I did actually get quoted for a couple other deals that we're doing, and our partners over at Massive was like, hey, if we do agency debt, I believe we can go even lower than that. So a lot of the underwriting I've been doing this week, the deals that are penciling out, it seems to me like we're going to start having a lot more deals pencil out. And so without further ado, let's bring Derek up here. Derek.
Hey, Alex.
Hey, brother.
I'm right here.
Hey,
thanks for having me.
Yeah, thanks for joining us. So why don't you give
a
little introduction of yourself, and then maybe we can answer some questions, and I have some questions for you so we can all learn together here.
Sounds good. Well, questions will probably be more fun because pretty basic for me. I've just been a lender for my my whole career here, and doing agency loans for Arbor now, as well as bridge and construction. So sort of running the full gamut of multifamily. We have a little offshoot that is doing single family portfolios and build to rent, and sort of looking at those in the same way you would look at a true apartment. There historically had not been programs that viewed the build to rent from a cash flow perspective and financed them like you could finance an apartment. So sort of do the down the middle of the fairway Freddie and Fannie stuff, and then also do some more complex things. And I think like that's a good way to view debt. As somebody putting together projects, like you really want to understand what your business plan is. Is this a true value add, and there's no there's a cash flow lift? There's decent cash flow on day one versus I have an exit dialed up in 2 or 3 years, or is there no cash flow day one? Is this a steady property, and really I'm just buying it to hold it? And sort of what your business plan is really dictates the best type of financing for what you need. But to respond to the first question, really all of the agency programs, like the small balance Freddie Mac program has they came out with a 40 basis point rate reduction across the board. Selling that like it's a a special or a monthly special isn't really the way I would view it. The agencies are always looking to do business, and they'll always be aggressive and give you waivers on the types of business they want to do. It's just a matter of knowing what they really like, and that's generally affordable housing. Buying something with some component of below market rent or lower AMI track, they're always going to price that really well and underwrite that really well. Conventional agency loans are generally 6 million and above, and the specials for those I think are a little bit better even. They're or what the underwriting tweaks that they're making to help make deals work right now. So for larger loans, they're considering 35-year amortization and underwriting over that in good markets for experience is something that's important to them as well. But affordable deals in decent markets, so I I wouldn't want it to feel like it's a, like it's a car dealership with like, we got a monthly special, and if you don't hit it this month, you missed it. I don't think that's the right way to view it. I think that the best part of the agencies is they'll always be there through every market to do your debt, and it's just a matter of finding the transactions that make sense for agency loans versus something else. Um, yeah, I'd love to answer questions or elaborate on anything. I don't know exactly where we're
Yeah.
what grade we're in here,
Yeah, so
or
let's
what.
just pretend we're in like kindergarten. So, I always like to bring it from the kindergarten aspect, because a lot of us just kind of start and we're like, oh man, I probably shouldn't be at the kindergarten level. So everybody's trying to understand higher level, and there's things that are confusing. So let's just go to start, right? How first,
Sure,
agency debt. I don't think everybody knows what agency debt means. So why don't you give
sure.
a definition of that first?
Yeah, so agency debt are programs that are either partially or fully guaranteed by the government agencies, Freddie, Fannie, or HUD. Really, everything rolls up directly to the FHFA, and then these three sub programs are just providing either partial or full guarantees to investors that are ultimately supplying the money to make these loans. The best agency loans are going to be on stabilized assets generally, so properties that have good cash flow on day one. That's going to really dictate how well the agencies underwrite your loan, is how well the property is performing in terms of collections and expenses, and today's NOI. How much income is the property making if we analyze it at one snapshot in time, which is today.
Yeah.
And so I think that's a good way to understand them, is that's the type of deal you want to think of an agency loan for. If you have serious delinquencies or vacancies, or there's a big value add or construction, like that's not really something that the agencies would do, though they will do some lease up on bigger deals. Anything I say as far as making a blanket statement should sort of be disregarded as the loan amount gets bigger. It becomes a more of a, we can figure out a way to craft that. It doesn't need to fit in the box, but $1 million and up is the agency minimums. But the smaller the loan is on that scale, the more kind of boxy it feels.
Okay. So for agency debt, it seems like, if I'm just listening from a kindergarten space, why wouldn't everybody just get agency debt?
They have some experience requirements, or um, they want you to either have, like Fannie Mae, for example, wants you to have owned a multifamily property for 2 years prior to getting your first agency loan, or you can live within 100 miles of the property. But you can't get an agency loan generally um, without a waiver or an exception, which can be made, but you generally can't until you have some sort of experience.
And so if I have no experience, what do I do?
You partner with somebody who does have experience, or buy something within 100 miles of where you live, or going for a waiver.
Gotcha. Okay. So agency debt, it just sounds like it's got lower rates, it's fixed, it's safer. Why are people getting into trouble these days? What are the
Uh,
scenarios in which, because I was at NMHC and there was so many people that was looking for help. I heard so
hmm,
many people that were looking for help in their properties. I heard some horror stories. I know there's a lot of people doing
floating
cash
rates.
calls, refinance that
Yeah,
they don't want to do. What's the story with that?
floating rates, I think are where there's stress. Maybe projects that were bought within the last year that had a value add component, that were projecting higher rents but weren't really factoring in expense growth,
Hmm.
and then use floating rate debt that maybe was 4% when you took it out, and is SOFR has gone up to 4.5%. SOFR was less than 5 basis points. Maybe it's been a year and a half or so since then, but so we're talking like over 4% up in SOFR, which is a floating rate, and then a 400 basis point or 4% spread above that. So you're talking, when you took the loan out, your interest rate was sub 5%, and today it's 8.5.
Hmm.
and maybe expenses have gone up too. So that's where the stress is.
So
Is,
that's,
is
yeah, that's obviously not an agency loan that they got into, right?
No, agency loan. There are some floating rate agency loans, and there could be a good reason to do that. That you're looking for a more flexible prepayment penalty. So I do a fair amount of that, but yes, but yeah, generally that's the business that's stressed today.
Hmm.
Are guys that did their underwriting with a 5 or 6% rate, and now they're at 8.5, and maybe expenses have gone up a little bit too, and so cash flow is tight.
Yeah. So they're basically in the red and they're bleeding.
Yeah.
Yeah. Okay. So is there a reason? Is it easier for them to acquire those loans than agency? Is it because there is less requirements that they have to meet? Is that also why people are taking those too?
You know, I think there was some of that. I think the lending market got really aggressive. You know, as there are more lenders competing for business, they tend to bend their underwriting to
Hmm.
make deals work. And I think there was some of that happening in the bridge space, like with private lenders and debt funds. I think that is historically not the case. That it's, you know, agency loans are normally just as easy to get, if not easier to get, I think, than like a bridge type of loan. You know, I think a bridge loan probably should want more experience, you know,
Yeah.
and a bigger net worth, because you're taking a deal that has an unstabilized component to it. You know, a stabilized loan should be a little bit easier to get than an unstabilized than a loan against an unstabilized asset,
Yeah.
if that
And so,
makes sense. So no, I
uh-huh.
mean, I think it's just that agency loans are sizing based on the current cash flows rather than the future cash flows. So if you have a vision for a property, that doesn't really get captured in the underwriting for an agency loan. What gets captured is the as is. You know,
Mm,
how are things performing today? And so the leverage, you might see this property as being bought you're buying it at a 7 cap once you get done with it, but today it's a 4 cap, and the loan will get sized off of the 4 cap. So, you know, you might be talking about a 50% loan to value if
yeah.
something isn't cash flowing really well. And you can go get a bridge from somebody who says, my exit could be owning the property. And so I'll do it at 70% regardless of the cash flow. So I think that's where the seeking extra debt, I think, is where that floating rate, comes into play.
Yeah.
It's when you want higher leverage on a deal.
Yeah. And Sylvius, I'm going to get to you in a second. I just got a couple more questions just to help the elementary level of thinking that, where I'm at. So, as a GP and an LP, right, in terms of underwriting deal and looking at deals to invest in, I think there was, people were really focused on this short-term returns. Like, let me go do the value add. I'll come in and it doesn't meet the DSCR, or maybe it doesn't meet the LTV, like, the number that we need to be at, but we have a plan to increase the value of the property. And that's why we're going to go here. We're going to put $300, we're going to increase the rents by 300, and then we should be able to exit 2x in 3 years. So there's a lot of promises like that as well. And I feel like that was kind of part of the issue. But as a LP, as a limited investor first, what questions, or in terms of the debt side, should they ask when they're investing into a deal, or should they be aware of?
Yeah, I mean, I think as LP, I'd want to know what type of debt they're using. You know, are they using a bridge loan? When is the maturity of that bridge loan? You know, what's the interest rate, and what's the interest rate risk? You know, some people get a rate cap on a floating rate. So you could theoretically have a rate that floats, but you could purchase a rate cap and have that built into the project cost. So I
Mhm.
think as an LP, I'd want to know, are they buying a rate cap? Are they using a bridge, or are they, are they using a 10-year fixed? You know, is it, what's the interest rate? I mean, I think I'd want to view it sort of like I would if I was a GP on it. I just would want to understand that. And then if you have fixed rate debt, it maybe limits some of your upside, because with a 10-year fix, you generally have a prepayment penalty. And so it sort of locks you into term. You could do a 5, 7, or 10, but you're locked in for 6.5 years with a yield maintenance prepayment penalty
Yeah.
that is worse if the interest rates go down. So that's sort of the intuitive way to understand yield maintenance is if rates go down from when you took the loan, that'll increase your prepayment penalty.
Hmm.
And that is possibly where we are right now in the cycle. I don't have a crystal ball. I wish I did, and nobody does, but it does seem like there's a chance that we could have slightly lower rates, in the near term future, certainly in the long term future.
Yeah.
And so if you get a fixed rate, that's the downside to that is it may not be easy to get out of it into a lower rate if you want to refinance. But if you take a floating rate and rates go up, you're dealing with cash flow issues. So I think it's matching up the business plan with the fixed rate.
Mhm.
If you feel like it's a substantial value add and regardless of where rates are, there's cash flow to exit, I think a floating rate bridge is okay. You'll finance more and then be able to recapitalize when the value add's complete.
Yeah.
If it's more of a stabilized buy, I think you want a longer term fix and you just say, I want the cash flow to be consistent. I want to know what I have. And there's not going to be a significant lift in the NOI. So I just want to mitigate the risk of higher rates. Because I think in the short run, it's tough to know, where
Yeah.
rates can go here. We're sort of getting conflicting economic data where you get positive, uh, net, bad is good right now. And we get a positive job report and the treasury goes up 35 basis points this week. So, we'd had the 10-year treasury is a good index to look at when you're trying to get a feel for where rates are. That's the baseline for a lot of fixed rate financing. And the 10-year treasury topped maybe a couple of months ago around 460. When I say 460, 4.6%, 460 basis points, that's sort of all the same way of indicating the same thing. But the treasury is down to maybe 355, 360 today. So we're 100 basis points off the high. But early this week on Monday, we were 35 basis points below where we are now. So we're just experiencing extreme volatility in the rate markets, which makes it difficult to project.
Yeah. Now, one thing that you did say, and I think a lot of people will be is confused by this because I was kind of confused by it because I never even heard of this term before. So the rate cap, how does the rate cap work, and what can you just explain what a rate cap is and how does it work?
Yeah, a rate cap is purchased through a third party company who you pay directly to supplement future interest payments should the rate exceed your strike rate on SOFR. So, for example, today you might take a rate cap with a SOFR strike rate of 4.75%. So if SOFR, which is your underlying index, ever goes above 4.75%, that third party rate cap provider will send you a check to supplement your mortgage payment for a fixed period of time. And you have to pay them a fee up front to do that.
Okay.
Um, yeah. So then there's some more complexities to it. Like if you are in the money, meaning the current SOFR rate is above your strike rate, you can terminate that and have a positive value. They were expensive for a while. When SOFR was really rising aggressively, they were very expensive. And they still are more expensive than they historically have been, though they've gotten quite a bit cheaper over the last couple of months, sort of reflecting that interest rates seem to be coming down.
Okay. So we're going to take some questions now, and then we're going to circle back at some point to try to understand why interest rates move and why the numbers come out the way they do, because I took a shot at asking you this question when we met in person and I'm still pretty confused. So for anybody here that's hearing all these terms for the first time and it's like confusing, if you hang around it long enough and you get into deals and you get an opportunity to see it live, and you hear it over and over again, you will understand them more as you put the pieces of the puzzle together. It will make sense. So if it's a first time hearing some of these terms, what you do not understand, write them down. Better yet, raise your hand and ask the question. Okay, like if you're here, be here like you're gonna get the $1 million information right now. Okay, so don't just let information come in and be like, I don't understand it. Is it stupid? You know, am I gonna ask? Just ask it. All right. So go ahead, Silvius. Go, brother.
Thank you very much. And thank you for so much knowledge over here. Thank you for so much. This is crazy. Like I haven't heard that term before. It works like insurance almost, right?
Yes.
That's what it is. It's an insurance pretty much. It's like a gap insurance or like
Yeah,
question
exactly
is
right. Yeah.
what is 2 years experience required in here? Because I'm coming from single family space and let's say I want to buy a $5 million deal and I've never did that before, but I do have 7 or 10 years of experience in real estate. How does
Yeah. No, that's possible. The best thing you can do is put together just a little Word document that has your experience detailed out and specifically focused on if you've owned 1 to 4s in the same market as the property you're buying, that'll be a strength. And then plan on having third party management, because that's really the only hard and fast part of not having experience. Is they'll want you to hire a third party manager and try and get some basic info on that manager, like how many units do they manage in total and how long have they been managing properties in that area. And you should be able to get a waiver generally on that. Just know that your first loan you'll have to do a little bit of that. And then that happens again when you go from 5 to 50 units to over 50 units. They view that as a medium-sized multifamily asset, and a 5 to 50 is a small multifamily asset. So just figure you're going to have third-party management again, and just sort of have some sort of presentation around what your experience and your background is. And then as soon as you have 2 years of ownership on your REO, you don't have to do that as much, unless you're going for more complex debt vehicles like construction or bridge. And then you're sort of back to that. I need to tell the story of who I am and and what I'm doing here.
all right? Then if you're a broker or a real estate agent and you've been in the industry but you don't have the track record of ownership, then you can't qualify. You don't have the required experience then.
You can qualify. You can you can get a waiver for these things. So that's definitely seen as helpful. Put that on the list. It's still going to require a waiver. And waivers, I don't want it to sound like they can't be made. Like every loan I do has some sort of waiver on it. Sometimes multiple. Like nobody is perfect at all ever. I mean, that would be a completely unfair expectation. You just want to work with the loan officer that you can be honest with, and can help tell your story, because that's sort of what you have to do, especially when you're growing into assets, is figure out like how best to tell your story and work with somebody who can best help you do that.
Thank you. I appreciate it. Thank you.
Awesome. Thanks, Silvius. Go ahead, Donna.
Hey, Derek, so my question is around VA loan. My husband is a veteran, and can you buy multifamily with VA loans? Is it worth it? And is that considered agency debt? And anything else you want to share about VA?
The VA loans, I believe, are just for 1 to 4s. On the agency side, there's no VA loan I know of for 5+ units.
Okay.
So maybe a residential loan officer would be the best person to answer those sorts of questions. There's no multifamily augmentation for VA.
Thank you.
All right, Hawk. I know what you want to ask. Ask it.
Hey, I mean, am I that predictable? All right. Hey, everyone. So I'm going to ask the obvious question. So, I kind of resonated with the idea that, agency debt, are better for stabilized properties, cash flow on day one. So there's a property that I'm looking at in Maryland that has a $62 million agency loan, 2.79, and it matures at 20 in 2056. Let me ask you this. What is the ideal situation for an asset with a loan with those type of terms?
Well, so that sounds like a HUD loan. If it's got that, yeah, that's a 223F HUD loan. Yeah, yeah. So yeah, there it is. Yeah, AJ. I mean, you do an assumption because if you were going to do a new HUD loan, you'd be north of 5%. So you go assume that baby and enjoy it. Enjoy the low rate. The only rub will be making an assumption is you can't raise that HUD loan. You're stuck with that level of leverage. So if you're paying, I can't remember what you said, 62 million maybe, or that's the amount of the loan,
That's the
whatever the
amount of the loan.
difference. Yeah, whatever the difference is between that and the purchase price is going to have to be your equity. And I mean, you could obviously take your capital stack in there and maybe get pref or whatever. However you want to layer the junior types of equity and debt in your capital stack. But yeah, you got to assume it. But yeah, if you can make the math work with your equity, oh man, like that'll really help cash flow.
Okay, great. Thanks, Derek. Appreciate it.
Sure. I wish rates were still that low. It was really fun. I mean, it's incredible how much it changes as far as the amount of debt that a property supports, the interest rate. In particular, I remember doing loans that were 2.5% for 35-year fixed. And that same loan is north of 5% today. So it's doubled. That's millions of dollars in loan proceeds on depending on the loan size, obviously, but on that loan, it may be 10 million short if you were going to do a new loan today.
Yeah, wow. It's huge. So since we don't have any other questions right now, I'm going to ask it again. So we talked about how they determine the interest rates, right? It's like the CPI that based on that report, and that is based on unemployment and inflation. Yes.
Yeah. Well, right. So really it's the agency rates are indexed above the treasuries. So the matching treasury, if you're doing a 7-year fixed, it's the 7-year treasury you're indexing over. And the treasuries trade off of investors' anticipation for the market over some period of time. Generally they look at, if you put yourself in the investor's position, I can either buy treasury bonds or I can invest in more risky assets like stocks or real estate or any of those things. If stocks look like a good investment over the next year, or real estate does, you're less likely to want to buy bonds, and the government has to raise the interest rates to get people to buy these bonds so we can fund our everyday operations. It's harder to find investors when they're optimistic about more risky assets. If you're pessimistic, conversely, if you're pessimistic about the stock market or real estate or any sort of riskier asset, bonds look really attractive. So it's easier for the government to find buyers of their bonds so they can lower the returns and still sell enough debt to fund our deficit and make our payments. So that's sort of that's sort of why that good news is bad news for interest rates. It's
Yeah.
good
So
news for good news for the market. Makes you feel like I should be buying stocks right now, not bonds.
that all sounds good, but it feels like the government just racking up debt at a astronomical rate. So is this whole plan like we're just supposed to be like, okay, well, that's a great plan. I guess we'll just listen and that's the way to go. But how come I feel like it's not really the outcome isn't really you know what
Oh,
they seem to be doing.
yeah, I'm not a politician at all, but yeah, no, they a balanced budget, like what would that be like? You
Yeah.
know, like absolutely, you should be just like any family. You don't want to spend more money than you're making and have to borrow to cover your deficit. That's not a long term plan. I guess if you have a printing press, it sort of throws the conventional rules out. But yeah, that's what that's what we do is we just have to print,
So there is,
and raise. Yeah.
yeah, and so based on what you just said there is a lot of people that are like, well, I would just buy, I can buy bonds, I can buy anything else that is safe 3-4% returns on my money. Why would I invest in a real estate deal that has the same cash flow? Right? Because that's what some people are saying to me. I mean, to me, it's common, it's common, it's logical, or not logical, but to me, like there's are other upside factors in real estate. It's not just 3 4
Well,
percent but there's
it's tax advantage number
yeah.
one, right? Like
Uh-huh.
you have depreciation that's offsetting, that's offsetting your income, so you're at least deferring the taxes on that. And you can do things like cost segregations as the loan gets bigger and accelerate the depreciation. A
Yeah.
cost segregation will break out your short term uh, components of the building that you can accelerate the depreciation over a 5-year schedule on versus the rest of the structure, which is 25. So you can front load that depreciation and have that same, let's say it's a 5% return, have that same 5% return without, paying the interest tax on it. And then in real estate, you of course participate in the upside. So if you hold the asset long enough, it's going to, the likelihood of it being more expensive than when you bought it is high. The
Yeah.
longer you hold, the higher that likelihood becomes. And then the third leg would be there's hopefully some sort of value add component when you're investing with a sound operator. They're looking for things like missed income opportunities, like this property isn't billing back for utilities and it should be. Here's an easy 120,000 that we can implement by just adding bill backs. So
It's
there are
hard to
some
find
like
that these days. But we do have a deal under contract that has that.
yeah, every once in a while. Yeah.
Yeah. So, okay, cool. Anybody else have any questions for Derek? I know debt is a really complex conversation. So, I'm trying to keep the questions like as simple as possible, but sometimes I do take for granted also like the information that I know. So, Hawk, let's let Bibby go first and then you go next.
Yeah, please, can you shed more light on yield maintenance?
Yield maintenance.
Mm-hmm.
Yeah. Yield maintenance is a pretty complex calculation. So it's difficult to you can't actually like do like if you can't do a hypothetical on yield maintenance. You can only do an actual yield maintenance. It's best understood when thinking of it from the standpoint of the investor that's making the loan, which is ultimately like a pension or a sovereign wealth fund. Like somebody at the end of the day is loaning you that money. Yield maintenance compares the rate and the spread, so the amount indexed over the underlying, or the amount of spread over the index versus the day that you're paying off the loan. So you're comparing the rate you got when you took the loan out to when you're paying it off, and compensating them for the difference if they can't redeploy the capital and make the same or a greater yield. So it's very hard to wrap your brain around because you're using a future value, to understand, what your prepayment will be for a loan you're signing for today. But
Yeah.
I don't know if I helped or made it worse with that. but that's
But
that's the idea, is if rates go down and the investor can't get the same return that they got when they made your loan, you're basically paying them for that difference plus some amount. If they can redeploy the cash and make a greater yield, then the prepayment penalty is going to be maybe even one of the best prepayment penalties out there, because it might be as low as 1%.
Yes.
Within the first year or two. It's just it's all dependent on what that investor's new opportunity to get income is.
Yeah. So definitely, to make it even simpler, hopefully I can make it simpler, is you're basically like compensating the lender for their opportunity loss for having you prepay that money to them. Right. So if they can deploy the money that you
Yeah.
prepay to them quicker to somebody else at a higher interest rate, so they're going to make money, then they charge you less. But if the interest rates are lower and you prepay, and now they have that you compensate them for the loss of the difference, like now they're going to lose money by re-lending that exact same amount out. You got to pay for that. And then they calculate like for, even the future money that they're supposed to collect. So it's complicated, but that's essentially kind of what it is. Am I on track with that?
Yep. Yeah, well put.
Okay, cool. Does that
Thank you.
help you, Bibi?
It does help. So that means if we have an high interest rate, let's say an high interest rate right now, and it goes low, that would be very bad for the person, right?
Yeah.
Okay. Thank you.
Yep, that would not be ideal. Yeah. I
Thank
saw a
you.
question from a little earlier that I missed too, which is what is the net worth and liquidity requirements for an agency loan? I'll just hit it real quick. For a small balance loan, it's the most box, and that's again everything that's 7.5 million and below, and it's a 1-to-1 net worth with the loan amount. So you're getting $1 million loan. You need the sponsorship group collectively to have $1 million net worth, and that is to say the GPs on the loan that are signing the carve outs, and then 9 months of post closing liquidity on bank statements. And these are again collective. You don't need to individually have that, just as a group be able to show that.
So 9 months of that interest payment, basically the loan payment.
In an amortizing payment, even if you're doing an interest only loan, you'd have to show
with principal.
They take what your principal payment would be times 9, and that's what you'd have to show. Bank statements.
Great.
Businesses would work too. If you have another property account that has money in it, they're reasonable in terms of stocks count, cash value of life insurance, all those little things count. So you can normally it's pretty easy to find a way to get there, and that's one of the easier marks to hit. And really in multifamily lending in general, I think the agencies are as flexible as it gets on that.
Yeah. And then what happens at the 20 million, 30 million mark loans?
There's with Freddie wants you to have between 7 and 10% of the loan amount in liquidity, which is more conservative. And Fannie doesn't have a formal requirement.
Oh.
So Fannie gives you more flexibility than Freddie does with that. Freddie gets quite a bit more conservative, and Fannie looks at it more on a one-off basis. I mean, they still like to see that you have 9 months, but there's not a formal number written in their policy. What
is the difference between Fannie and Freddie? Because last time we spoke, you're like, hey, Vegas is a good Freddie market. So what does that mean?
Yeah, a ton of differences, really. There's differences in the execution, and with the Fannie Mae loan, Arbor, they're delegated lenders. So Arbor, who I work for, is a delegated lender, meaning most Fannie Mae loans we can underwrite and fund ourselves, without bringing somebody in from Fannie Mae to have a part in the underwriting or the funding. They are just sort of an entity there that guarantees the loan, and it's a Fannie Mae loan, but it's, they don't have an active role in it. With Freddie has an active role in that process, so it moves a little bit slower. So that's sort of structurally how that feels a little different. In practice, on individual loans, they each have their own risk ratings and appetites in different markets. So like Vegas happens to be one that Freddie grades as a standard market and Fannie grades as a pre-review market. So there's some additional scrutiny that goes into doing a Fannie Mae Vegas loan that doesn't happen for a Freddie loan.
Yeah. Okay.
So it's pretty important to not necessarily pick one of the shops, if you're at Freddie or Fannie or HUD, without knowing all the details about your project, and where it's located and what liquidity we have. All of that sort of will go into a formula and spit out what the best program is for this particular deal.
Mm-hmm. So if somebody is looking for a loan, would it be fair to say that it's best to go and shop through someone like, say, you to find a loan for them?
Yeah, I mean, I'm a direct lender, so happy to, at any time to give anybody my thoughts on if it is a good agency loan and which would be the best. There are direct lenders and then there are mortgage brokers, so it's just important to understand who you're talking to.
Mm-hmm.
A mortgage broker will go get you quotes from somebody like me or a credit union or a bank and bring them all back and normally charge you a fee. A direct lender like me is actually writing the agency loans, and if we're charging a fee, it's to buy down the rate.
Got it.
It's not like a brokerage fee. So just important to know who you're shopping with. And then, I think in general, like be really skeptical of people. There are a lot of people that aren't analytical when they're looking at things. And I think you should always look for that. I think you should want somebody doing your loan to really understand, the nuance of how the property's underwriting and the programs. And, I think like red flags to me would be if it seems too easy, if there aren't a lot of questions, if they're, like that sort of stuff, like should sort of, throw up some red flags. But yeah, shop and ask and, and talk to people, talk them through it and find guys that you're comfortable with.
What would
that
you
you
want
think will do a
people
good
to,
job.
if someone was to come to you, what information would you want to have? Because I feel like there is, so everybody's gonna get Derek's contact info and a follow-up email as well, because there's a lot of people out there now, so many multifamily teachers and so many people getting into this game. Everybody is underwriting a whole ton of deals, and I imagine that brokers are just getting flooded with just underwritings and OMs and what do you want to see when people give you something so that they're like serious to you?
Yep. So I want to understand first what the business plan is. And then I want to see, so is it a value add or, what do you see in it? What is your plan for the property? And then I want to see a rent roll, a trailing 12, and then your budget, your budget for the property's cash flows. So I'm basically trying to understand how it's operating today, currently, and then how you think it's going to operate, when your plan is achieved.
Should people like write a little paragraph to you or something, or what do they send you to tell you their business plan?
Yeah, no, it could be really simple, even just saying like, hey, this is a value add, doesn't need to be anything formal at all. It just could be something like, hey, I really like the value add component to this, or the cash flow looks great, so just I want to understand like what they're looking at and what they see in the property, so I can start thinking about what sort of debt is going to make sense for what they want to do.
Gotcha. Okay, Hawk, go ahead. Thank you for waiting. I had so many questions.
No, he answered my question. My question was net worth required for loans, and he knocked it out the park. I'm just trying to figure out. So let me ask another question. So, between agency debt, so the loan I'm looking at is a HUD loan. So HUD loans fall in two categories, right? Freddie and Fannie. But how do you figure out which one is which? I'm looking at the note. It just keeps referencing HUD.
Well, HUD is actually its own program. HUD is a completely different agency program. Yeah, you have Freddie conventional, Freddie small, Fannie conventional, Fannie small, and then HUD as its own. And you have a 223F, which is a stabilized property, and then you have a 221 D4, which is a construction loan for HUD.
Okay, so all right. So for what's the net worth required for a HUD loan? For
You're doing an assumption.
an assumption, yeah.
HUD, I mean, they all will sort of like a 1-to-1, but HUD is another one that doesn't have a formal ask for the net worth. And that you'll find that that's true as the loan amounts get bigger. You know, like that anything over 7.5 is not going to have a formal net worth requirement. They're going to want to see that you have similar experience, you know, or somebody in your equity group does. If you want to assume a loan on a 250 unit apartment, they're going to want, in a particular market, they're going to want you to have some sort of experience that makes them feel comfortable that you can manage that. You know, if the biggest you have, and so sort of growing within scope, if you want to do it on your own, I think it's important. You know, if you've had a 5 unit, you know, it's okay to go to a 45 unit, or to partner with somebody who has a 250 unit if that's what you want to do. But that's going to be more what they're focused on than your actual net worth is going to be your experience managing similar assets.
Okay, great. That's great advice. Thanks.
Yeah. So I'm gonna just ask a couple last questions. So and then I'll let you go. But we have a deal. It's 193 units, $30 million. There is 60 units that still needs to be renovated. So we're gonna have in reserves an extra $500,000 that we're gonna raise for that. What if we're looking at a Freddie loan in Las Vegas? What interest rates should I be underwriting with?
Does the going in cash flow give you enough debt to make the deal work?
Yes. So it will cash flow day one.
Okay.
And so
All right.
what interest rates, you know, on low end and high end, what
Yeah,
should I be
yeah, yeah.
writing in there?
I would say, and if you're going, you know, direct, that will help too. I would say something in the range of a 175 to a 215 spread over the 10-year treasury is probably a pretty safe range
Mhm.
to stay in. Or if you just want to put 200 in, so meaning 2% over the 10-year treasury, which is, let me see. Yeah, and you can probably do better than that in reality when we go in. So
Mhm.
we'll go in and ask for pricing waivers and try and, you know, get your rate down. But I think if you're using a 200 spread, you're probably playing it safe. And the 10-year treasury closed today at 367. So I'd be using a rate of 567 to underwrite it today. And then figure if I can shave a quarter point off of that when I get the loan, I've done well.
Okay. Awesome. And what are some terms? So like we look at 10-year, 5-year interest only, like what's around right now?
Yeah, the longer the fixed term, the more interest only you can generally get. It's got to most importantly match your business plan, and so that's what I would, the lowest rate is the 10-year, and then it moves inversely 7 to 5. 5-year money is the highest. But knowing what I don't recall, somebody mentioned it earlier that if rates go down, our prepayment penalty could be worse.
Mhm.
Knowing that, what's your business plan? Are you going to improve the cash flows enough that in 5 years you're going to want a cash out loan? So is it
Yeah.
worth paying extra on the interest rate today to be able to recap in 5 years? I think those are the right questions to ask, and matching it to your business plan. Because you're paying for it. You're paying for the flexibility to be able to refinance in 5 years, to not have a prepayment penalty on it. You might have to pay an extra 40 basis points on top. So maybe you're using, a 6% rate to underwrite instead of, maybe that might be a little high, but maybe like a 585 rate instead of a 565 rate. So you're paying a higher rate to get that flexibility. So I would want to know from you, what do you what's your vision for it? Is it a recap in 5 years or
Yeah,
maybe even less
definitely. I
spent?
think it's definitely a recap in 5 years. Because A, they're below market rents. B, they have 60 units that are still going through renovations out of the 193. So there's
Mhm.
going to be a big increase in NOI. Plus, this property just went through this like Vegas CHAPS program, and there was a lot of delinquencies because of that from COVID. Vegas is like slow with the applications, but that's
Mhm.
already done with. So in the next quarter or so, that's all going to stabilize out. No,
Mhm.
Andrea, it's a different property. And we're looking to submit this LOI this week. So I just want to get a second opinion, or maybe this is actually
Yeah.
the fourth opinion, but yeah.
No, I would
Yeah.
I would absolutely, with that sort of business plan, I would think doing something like a 5-year fixed with maybe even 3 years of yield maintenance is
Mhm.
probably worth paying a little extra on the interest rate. Is giving yourself the flexibility to go take a cash out loan as soon as 3 years down the road, or just rate and term refi for a better rate. If that opportunity presents itself.
Mhm.
Um, and I would rather not see you use a bridge loan on that, just because the bridge loan, and that sort of starts to look more attractive if the cash flow is worse day one. Bridge loans start to be more attractive. You just have to carry an 8.5% rate, and bridge loans are inherently a lot more expensive than doing a stabilized loan. The cost to close a bridge loan of, let's say, 20 million could be 350 or 400,000 bucks.
Yeah.
That wouldn't be uncommon on a bridge, and then you'd pay over 8%. So there are some deals that just don't have enough cash flow day one, and they have enough juice in it once the value add is complete, that it's worth paying those extra closing costs and having that higher rate for. But if you don't have to, and the cash flow is good enough, like it sounds like it should be here, I would just think you do either a 5-year fix with 4.5 years of yield maintenance, or 5-year fixed in 3 years of yield maintenance, and give yourself some flexibility and keep your costs down on the acquisition.
And what will we get? Will we get like 3 years interest only on that?
That's on the high side, I think, for 5 years, but it's possible.
Uh-huh.
If the LTV is lower, if it's affordable, and if it's affordable and at 65% loan to value or better, you might even be able to get full term interest only right now.
Yeah,
But
that
if you want,
I did get quoted. I did get quoted 5 years, 5-year IO. So that's why
yeah,
I was like, okay, well, is this real?
yeah,
So
yeah, that is real. That is real right now. Yeah,
I like it.
that's one of the program enhancements. Yeah, so 65% loan to value and affordable, and you should be able to get 5 years on a conventional size loan. So above 7.5 million. When you're below 7.5 million, you don't have as many fancy programs
Yeah,
available.
got it. Got it. Well, that was very helpful. So, I hope that you guys also see, like, when you guys get involved in deals, your questions become a lot more impactful. Like being in rooms like this and hearing and being able to ask questions to someone like Derek when you have a deal going on, like it's a difference of, probably millions of dollars at some point. Right. So this type of information is super important. So thank you guys for, saying yes to being here, even though Brad's got this big thing going on at the exact same time. So I hope that you guys are taking something away from this. Look for the nugget, look for that golden nugget that you're like, all right, this is this is $1 million information right here. So yeah, thanks, Derek, for being here. And anybody else have any last questions for Derek? Well, I guess we covered a lot of stuff. And I have all your information, Derek, so I will send it out to everybody in an email tomorrow. But you guys have questions for Derek, or we can also take a look at the underwriting I did for this 193 unit deal. Going once.
Let's take a look at the underwriting.
All right, awesome.
Sounds good, guys. I appreciate it. And I'm here if you need me anytime.
Yeah.
Seriously.
Thanks, Derek. Really appreciate you, man.
Good night,
Derek took
everyone.
so many. See you later. He took so much time just hanging out with me at the conference. We were just standing there talking for like an hour and change. Just so much information. I was like, hey, you want to come on to a call on Thursday and share with people's here? And he's like, sure, of course. So very generous with his time and wealth of information. All right, so okay, let's take a look at this deal. Okay, so we looked at this deal. We did get two different quotes on this deal. Wait, hold on. Where's my other Zoom screen? Here we go. I can see everyone. So I did get two quotes on this deal, and one of them was a 10-year. 10-year, it was 5.25, 10 years, 5-year IO on this deal. And then I also got a 5-year, 5.5% interest only for the entire duration, 60 months. So, you know, like Derek said, is this something that you want to short-term recap in 5 years? And yes, we do. We don't want to hold this out for 10 years just collecting the cash flow. Yes, we want to look long-term, but we do want to get our investors' money back as fast as possible. So that's our goal. That's our plan. And we underwrite most of our deals this way. So this deal was also under contract for $44 million last year. And now we got an opportunity to go in at 30 million on this deal. It may be a little bit more, but you know, the broker's like, submit something with a 3 in front of it. And here it is, 3 with zeros behind it. We've set aside $500,000. So just to, this is the Michael Blank sheet. If you guys don't have the Michael Blank sheet, purchase it. It's one of the best purchases. It's $150. You get a video on how to underwrite on this sheet. So do yourself a favor. I think this is probably the best sheet that there is. I've seen so many ones out there. It's so complicated. So many things that just are unnecessary, right? And I do my napkin underwriting in here as well. So if you see the first column, this is very like napkin underwrite. I take the T12, I stick the numbers in here without putting in all these numbers. These numbers, when I put in these numbers, I'm serious about the deal now because I'm looking for real insurance quotes. I'm looking for the real taxes. I'm looking for the real management fees, like all the things I am going to get real numbers on, right? So, but the interest rates, we're just going to go with 550. Okay. On this deal. So, let's see. I'm going to go with scenario 2 and 3. I'm going to show you guys the difference between 2 and 3. 2, okay, usually in the T12, they're going to give you your total rents. Okay. They're going to give you a total rent with all the vacancy, concession, all of that built into this number. So I'm going to put that there. And as is right now, 25% of this property is affected by the CHAPS program. That means they have delinquencies. They're, you know, they owe $10,000, things like that. But when they get, so they're going through the government program that's helping them pay the rent. When they get approved, and the management company is helping everybody get through this as well. So they've stopped taking applications. So this is not a thing moving into the future. But while they're doing this and getting approved right now, when they get approved, all that back rent gets paid. So this is what this current seller is dealing with, is 25% of the people not paying and owed this money. Hopefully by the time we close right around the time where they start to pay us the rents, the $10,000 back owed rents, because that'll be ours. That's not theirs, right? So we're going in that way. So that's one of the upsides about this deal. When you underwrite like this, though, your average monthly rent's going to be off. So when you go into your P&L section, your monthly average rent's going to be off, and you can't really tell, am I at the market or am I not? So it's better to always underwrite it with their gross rents, and then compare them. What we think we're going to get it at. Historically, what is this property renting out for? What's the vacancy rates? What's the concession losses? So it's historically 98%, but we're going to do 5% vacancy, 5% bad debt. Okay. It's plenty for the year. That's 127,000 loss, 127,000 loss from that. So we program it in here. These are the two different options that we're going with. The first one is as is right now going in. And actually the management company just got back to me. So one of the tricks that you can also do is build a good relationship with a current management company. Okay, I'm talking to the management company and we're like, hey, we got other deals. We want you to manage too. Can you take a look at my underwriting on this deal? There is some conflict of interest, but they're okay with giving us the right guidance. And he's like, this first one that you created, your first version, he's like, it's way low of what we're even operating at right now. So I'm like, okay, that's great. And he's like, this is more like the numbers. So I'm like, okay. So we will be looking more at this third projection. This one was just, worst case scenario. So even at the worst case scenario, let's take scenario 2. We are looking at somewhere around it's not bad, right? It's not bad for what we're looking at in today's market. Most deals don't even fit this. And it's positive cash flowing, even though it's not much, but it's positive cash flowing. Also, all the deals that we do, we run 70-30. Okay, so if I push this to 80-20, this will also be higher. But because the deals that we do, like if it fits and if it can cash flow and perform like this, while it's at 70-30, this deal is got a lot of room and it's a really good deal. And I also believe that the amount of work that you put in to make a deal like this happen and run it and make money for passive investors, I feel like 70-30 is a very, very fair number. Okay, I used to do single family management for my investors. I used to do 50-50. So for me, this is definitely, and I made a lot of people a lot of money. So for me right here, 70-30, super fair. And that's just, when I look at deals, I do 70-30. If it's 80-20 and I have to finagle all these numbers just to get to a certain number, I'm like, the deal is so skinny. Okay, we're not going to get paid. So we're basically running a deal for our investors and everyone's going to be upset because there's no money being paid out. So that's why we do a 70-30. Okay, if the GPs are happy, the deal's going to be happy and the investors will be happy. So that's my philosophy. Everybody gets a win. Because some people are like, oh, it's 80-20. Well, Grant Cardone does 80-20. Well, the deal's also $100 million and he's got, he bought the deal cash, right? Okay, so that's scenario 2. Scenario 3 makes this deal look awesome. All right, now we're looking at 22.03 average annual returns. We're looking at 110% returns on your money in 5 years. This is a very, very good number for a 70-30 split deal. Go ahead, BB.
Okay. How do you structure? I know that's not what you're talking about, but I want to know how you structure your acquisition fee.
Yeah, so acquisition is right here. It's everything we do is 2-2-2. 2% acquisition, so scenario 3 is changed. 2% acquisition, 2% management, 2% disposition fee. So it's a 2-2-2 across the board.
Yes. How do you share it with your GPs?
So the GPs, right, putting this deal together, doing everything in the beginning, there is an acquisition fee on this deal. $30 million is $600K that goes to the GP and splits it between the table. So majority of the money for general partners is made here. This is why a lot of syndications, you see people liking to enter and exit deals a lot. They're not really looking out for the investors on the long run. I mean, I take that back. I don't think that that's true either, but there is a little more incentive for people with higher acquisition fees. I talked to somebody at NMHC, they charge 5% acquisition fee. It was pretty insane. And if they're doing a great job for their investor, all the power to them. 2% asset management fee that comes down here. $51,000 a year goes to the general partners, split between the general partners. So this is the cash flow. 2.8% to start going in. And then it will build up. And this is a pretty, we are still below rents. Okay, this is also below market rents. And I'm always very conservative on the increase on the rents. And this is what has always paid off for me in all the real estate deals I've done. Because I'm so conservative on the increase of rents. And if the deal can work out, like right now, the rents for these units average should be like somewhere around close to 1,200. So that doesn't even hit until like the third year. Okay, somewhere between the second and the third year. In this pro forma. And so let's see. So we will the returns, total returns is 174% for general partners and limited partners. And 104% goes to the limited partners. That means in 5 years, we can get a 2x, we can cash out, recap. You know, we could sell the deal or we can recap and continue to run this deal. I like to think of deals in terms of 10-year lifetimes. At least in my mind, I want it for 10 years. If somebody comes and offers us a large amount of money to get out at some point, then yeah, we will. Another thing that's going for us is in our real estate club call with Grant Cardone on Wednesday, he just announced that he is going to be looking at deals in Las Vegas. So like I said, a couple months ago, or maybe 4, 5, 6 months ago, I've been talking about Vegas. I told you guys that next year or the year after, there's going to be a whole ton of syndicators coming to Vegas. And that's going to cause cap rate compression. It's going to be like Tampa. It's going to be like Fort Lauderdale. It's going to be like Dallas, Houston, these places where you're not seeing the cap rates go up with the interest rates because there's so much demand. There's so many syndicators fighting for these deals. So I think that we're on the cusp of that happening in Vegas. I want to get at least 5 to 10 deals before all of that goes down. And it's my backyard. I love it. I know what's happening. I know the transition that Vegas is going through. Dwight is also here as well. He can attest to that. Anybody that lives in Vegas can attest to what's going on.
Yep.
And the great thing
Vegas
is,
rocks.
if you go on Crexy or whatever, you know, this is a great thing is if you're not in Vegas, you're probably not really seeing the deals that are being transacted because it ain't on Crexy, it ain't on LoopNet, it ain't on all the other sites out there. Because you see like Crexy, the deals that you see is probably, you may find a 32 unit townhome deal that's been on Crexy and LoopNet for like 20 years. That is a deal that nobody's going to pick up. It's just dead. You know, so there's a lot of those deals and people are like, well, there's no deals in Vegas. Where are we looking? It's all transacted inside. You know, I got a phone call the other day and I did in our group, I do a recording with the broker, like a call with our broker for educational purposes for everyone in our group to listen. 292 unit deal in Las Vegas, kind of inside the box of where we were looking. And it's exciting. There is a lot of opportunity there, but also a lot of risks in that deal. It's an all VA deal. It's like, it's a nonprofit organization running housing for VAs. So, you know, we have some people on our team that are veterans. And, you know, I want to bring in the team that knows a lot about veterans and, you know, we can actually make a difference. I would love to be in a real estate deal that is just more than just money, that we can do something great. And this is why I love the Vegas deals, because art brings inspiration, brings courage and brings all of that into a space. So I love like being able to do real estate and promote art at the same time. So yeah, that's the deal. Any questions about underwriting in this sheet? And we're kind of coming to a close on this.
Alex,
Yeah. Hey.
hi. Do we have any T12s on the drive that we can practice this with?
Yeah,
For-
I'll post it in there for sure.
Okay, perfect. Thank you.
Mm-hmm. So yeah, this is coming soon. Not 100% sure, since it's not a 506c or anything yet, if I'm dancing on the gray line or what. of priming people in the Vegas market. I'm not telling you guys the deal, but just sharing underwriting for educational purposes. Foreshadowing. Is that gray lines? Maybe. How did you come up with 500K repairs rehab? So we talked to the maintenance company that's doing all the CapEx work. So it's about $8,000 per unit that they're renovating to the high end. That gets you the stainless steel refrigerator, stainless steel everything, and it makes it look real nice. So 8,000 times 60 units is 480K. So we've budgeted $500,000 for the rehab and repairs. And by the time they're actively doing it right now, every tenant that moves out or gets kicked out, they renovate the units. So, they're doing a really great job. Stout is a really awesome management company out here. I'm most impressed by them out of all the ones that I've interviewed and looked at. I'm trying to get them to manage our 30 unit deal, but it's too small for them. And I'm like, I want to call tomorrow anyways to try and plead my case of why you should take us on. So wish me luck on that call tomorrow. I don't like to take no for an answer, or I don't take no for an answer from management companies. We can always work something out. That's what we got in the Fort Pierce deal. Our storage deal that we just closed. We got a Class A management company to manage our Class C storage deal. Sick. And they're going to be helping us and overseeing our CapEx work on the entire project. And yeah, we get Class A operations. That's value add right there, FYI. Have you started? Yeah, that deal's been cash flowing day one. That is a insane deal for a lot of our investors. We went into that deal. Our underwriting did not include all the parking spaces. Our underwriting also did not include the office space that the seller actually vacated. We didn't think they were going to vacate. We thought we were going to keep the office. So now we got another $1,200 a month for income. And for anyone that's trying to understand what that means, $1,200 extra dollars times 12 times 12, 1,200 times 12 months, 14,400 cap rate. Let's just say it's a 6 cap. That's $240,000 that we've gained in value by getting that office that we didn't think we were going to have before. So, and we've rented out a bunch of parking, and it's already doing better than expected. That was a deal though that took a lot of balls on our side to do. Everybody that was involved, it took a lot of faith, trust, and balls to go into. $300,000 hard day one, doesn't land as part of the deal, and 30 days to close. No extensions, period. That is a scary deal to go into to do. But we believed this so much. I was like 100% yes. Like, you know, and I operate it every day. Like if I didn't have it done, that I was going to lose my right arm. It's very extreme, but sometimes I play this game with myself of how committed I can be. I'm like, I'm going to lose my right arm if I don't make it happen. And I trick my brain into it, and then we just go and raise money. Interesting tactic, but it works for me. If you want to borrow it, go for it. Other thoughts, questions? We got a couple more minutes. I'll hang around for 5 more minutes with you guys. How can I help you guys move forward? Where are you stuck? Everybody's just doing such an amazing job. Finding deals. Yeah. You know, and I also say to a lot of people, you don't need to find, you don't, if finding deals has been challenging for you, there's somebody else that is sniffing out deals, you know, work with them. Work with somebody on it, especially if you're out of the country and you're finding deals. You need to be with somebody that can go and walk the property and do all that. Raising capital. Yeah, raising capital is definitely, you got to be talking and connecting with people all the time. You have to know how much people are willing to invest, how much they have to invest. And, you know, just sharing with people what you're up to and planting seeds, because I don't expect people to be able to raise what they think they're going to raise the first time they come into a deal. Right? We had like 6 new GPs in our 4 peers deal. And, you know, I don't expect everybody to be able to raise that money. People are like, I can raise 300K. I'm like, all right, cool. They raised nothing, but I'm still cool with it. My expectations weren't there, like right off the bat, you know? But I'm sure that the second deal comes, they'll raise 50K, 100K. Third deal comes, they'll probably raise 300K. So it's, you know, my philosophy is about building a team and moving forward with, you know, creating new GPs, giving people the opportunity. Go ahead, Natalia.
So what would you say as we start doing this, like raising capital, finding deals, like what would you say would be the best kind of like, how do you discover like what you're great at, so that like, should I focus on what I think I'm better at? Like, how do you discover that? Do you do a little bit of all, and then what you like, what makes you excited? Like, what would be your take on that?
Yeah, I would say it's no different than all my outlook on philosophy and life, period, is if you can have joy doing it, then that's where it's at. If you can wake up excited about raising capital and talking to people about the deal, great. That's where it's at. If you wake up and you feel so much pressure about talking to people about the deal, maybe just what else can you do? Right? Do you like to work with Canva? Canva is actually a skill that every team also needs. You know, being organized, somebody to organize things, you know, that's a skill that every team needs. Can you underwrite? Can you continue to underwrite? Are you a good analysis, analyst? You know, do the things that make you excited to be a part of a deal. Walk properties. If you like walking properties, talking to brokers, then you're going to be seeking out and sniffing out deals, because now everyone thinks that that's what they're doing to find deals and that's their only contribution. When you do enough broker conversations and when you know the market enough because you've been seeking out deals, you now have information. Like, information is great to leverage. Your understanding of the market. It's not just about finding the deal. It's about, hey, I've talked to every single broker here. I know all the deals. Well, somebody on our team knows all the deals in Florida that pops up, because that's all he does. Every day he just calls like 10 different other brokers and he's got all the deals. Yeah, I have fun doing Canva stuff. Awesome. We have somebody on our team that, you know, really stepped into Canva and is making and made their way onto the general partner team. Bank real estate owned. No, I don't, but maybe you do. That could be your superpower, right? I don't look in there. I actually haven't even like been looking at deals because so many deals now just come to me. And a lot of people are like, hey, what about this deal? Do you want to partner on this deal? So there's so many deals I'm looking at that's kind of like already vetted by people. I haven't even, I mean, I've been talking to some brokers here in Vegas, but I have not been talking to brokers in Florida like I was, because there's a team doing it now, you know, and yeah, thanks. You're a superstar. Yeah, so it's been really fun. And since you guys have stayed this late, I want to give you guys access preview. And Nick, send out the link to join our after parties, our Discord parties. And this is about to blow up. Okay, what we're gonna release is gonna change this entire game. All right, there's a couple other big groups that are going to be joining us in this community. Hala's going to be joining this community. So you're going to see like it's like what is that? Clubhouse, WhatsApp, and Zoom put together in one place. Sick. And if you want to, we created a general public area for everybody. Yes, I believe Pace does use it. I heard. So there is the link. Nick has put the link. If you're interested to get, you know, how to join us in this community, sign up there. We will send you a link to be able to join with us. Just to share with you guys what it looks like. Hey, if I hit this button and I create a stage, this is like a Clubhouse. You know, everyone's going to get a notification. There's a stage, there's audience, people are watching, listening. You know, maybe me, Hala, me, Mike Bailey, somebody's going to be on here talking, you know, about something. It should be random pop-ups. I had a vision of having 24-hour networking. I've said it so much, and here it is. Everybody can be here. Any given point, you might find somebody that's just hanging out in the voice channel. And you can connect, talk to somebody, underwrite deals, ask questions. All right, there's going to be multiple communities coming together into this one hub, and you're going to get a chance to network with so many people. Yay. So then you may be privy to Discord already and the power of Discord. I don't know how he runs his, but we also have a Legends Mastermind. This is for our paid mentorship program people. And we have tons of fun in here all the time. We underwrite tons of deals. We have resources of all of our calls listed here, our deal tracker, the deal that we have going on, Google Drive to everything that we also offer for our peoples. And then there will be a common ground area. Another great thing about this is if you're in here, and we have some programmers, including Nick in here. He's created different bots for us in here. If I go here to the common grounds, oh, look at that. AJ posted yield maintenance. You go to /check-in. Okay. For the next 90 minutes that you're active on here, it will track the hours that you are spending on real estate. After 90 minutes, you're going to have to check in again. Okay. So this is so that nobody just leaves it in here and just gets 24 hours of hours. We want to keep it legitimate and real so that you can use this potentially as part of your 750 hours of real estate professional, like a tracking for it. So that's available there. The other thing that's really cool is we have an underwriting bot that Nick created, which is, you know, it's very simple right now, but it's going to get more complicated, which is if you type in /problem on any chat, the bot will spit out a scenario in which you find a 183 unit deal. The average rents in the building's $1,100 a month. Property is 76% occupied. What is the NOI assuming 50% expense? This will all be randomized. And then you can do /answer. And then you click on this guess thing. I think you have to do that, or you may not. But you put 100,000. And the bot will say, nope, that was incorrect. The NOI is actually 917,928. Right. So it's pretty cool. You get some practices. This is going to get a lot more in depth. There will be, no, somebody else did it. There will be finding the debt, finding the cash flow. Does it meet the DSCR? So all of that is happening. Nick, 16-year-old, creating this. All right. What else? Yeah. So you'll
Leaderboards?
see. What was that?
Leaderboards.
Oh, right. What is that? Oh, okay. Leaderboard. Let's see who's the of active time. Oh, Hawk, man. You got to beat me by that much. So this is how many hours that you've been spending in here. You can take a look. All right. We've been beta testing this for a couple months now. So, all right. Hawk is number one. He's spent the most amount of time in the Discord with people. Okay. So, you know, as we are sitting, like you see, we are just sitting in this room, all different times of the day, we jump into this room, we talk about deals. Like, you're basically getting access to me and people that are, you know, people that understand underwriting, understand markets. We talk about different markets, different deals, like all day in here. So this is how people get like much more proximity to myself and from other, you know, people from Massive Capital. Like, they're going to have their own room in here. The multifamily freedom chasers will have their room in here. So you guys will see. This is a really game changer. That's what's going to be created here. We can have like 10,000 people at a stage at a time. You know, we can have like 200,000 people
Yes,
in a
I'm
Discord
here.
channel. Huh?
Oh,
What?
I realized it wasn't muted.
Okay. All right. So that's what's going to be available. Click on that link. Check it out. Join. We can have an after party at the Discord. Let's see what questions are here. It won't replace Zoom because there's some features that Zoom has that Discord doesn't. So it'll be a Zoom, Discord, back and forth. But we will be replacing WhatsApp though, because WhatsApp sucks. It doesn't suck, but it's just out of control now. All right, then. I will see you guys in Discord. Have a fantastic night. You guys are amazing. Talk to you soon.